So you're thinking about buying your first home here in Calgary, but maybe you're feeling a bit overwhelmed or confused. Or maybe you're getting advice from a family member who bought a home 30 years ago and you still don't know really where to start. Well, this video is for you. I'm going to be giving you your complete step-by-step roadmap to buying your first home in Calgary. And by the end, you'll know exactly what to do, when to do it, and what to expect along the way. I'm Ryan Hawkins. I'm a real estate agent here in Calgary, and I've helped many first-time homebuyers using this exact roadmap to get inside their first home. And when you're ready, you can click the first link in the description and you can book a call with me. Whether you're ready to buy a home now or you're just starting to plan, I can help guide you through the process from start to finish. Step one is understanding your first time homebuyer savings tools. The first thing you need to know as a first time homebuyer in Calgary is what savings accounts you have access to. Let's start with the FHSA, or the First Time Home Savings Account. If you don't have this account set up already, this should be the first thing that you do before you begin your search. And so, who is this for? It's for first time homebuyers. With the FHSA, you can save up to a total of $40,000 in this account, with a yearly contribution room of $8,000. The best part of this account is that your $8,000 contributions each year are tax deductible. That means they come off of your overall income, which means you pay less taxes. The best part of this account is when you put money in, it grows tax free, so that when you take your money out of that account to buy your first home, you don't pay any taxes on that amount. In short, it combines the best parts of the RRSP and the best parts of the TFSA, combined specifically to buy your first home. The second savings tool is the RRSP under the home buying plan. The difference from the first home savings account is that when you take the money out of your RRSP, you do have to pay it back. Now, this option has been around a lot longer than the FHSA, so if you've been saving for a while, you might have a lot more money in your RRSP. Recently, the Canadian government has made some changes and increased the limit from $35,000 to $60,000 per person. So if you're buying with your partner, you both have access to $60,000 per person, or combined up to $120,000. Step two is the minimum down payment rules. In Canada, the minimum down payment depends on the price of the home that you're buying, and recent federal changes have made a big difference. So here's how it works. Let's use the example of a purchase price for a home for $600,000. For the first $500,000 or less, it would be 5% of the purchase price. So for this example, that would be $25,000. Then it would be 10% for the portion above $500,000. And in this example would be an additional $100,000 to make up to the $600,000, which would be an additional minimum down payment of $10,000. In total, for that $600,000 house, your minimum down payment would be $35,000. But here are the new rules that have come into play. Before December 15th, 2024, if you bought a home that was over $1 million, you had to put 20% down, no exceptions. Well, now that threshold has been raised to $1.5 million. This means you can buy a home up to $1.5 million with less than 20% down, as long as you qualify for the insured mortgage. For example, under the old rules, if you would have bought a home for $1.3 million, you would have had to put 20% down, which would have been a total down payment amount of $260,000. Under the new rules, that same $1.3 million home only requires a down payment of $105,000. That's a massive change in the amount of down payment you need up front. Another important change is for insured mortgages. The maximum amortization rate has been raised from 25 years to 30 years. By adding these extra 5 years, you're dropping your monthly payment because you're spreading the loan over more months. This can make a big difference in your monthly budget, especially when you're buying your first home. It can also help you qualify for a higher priced home because lenders are looking at your monthly payment when approving your mortgage. Now, there is a bit of a trade off here. Over 30 years, you are going to pay more in interest than you would have in 25 years. So you are paying a lot less monthly, but you are paying more in the overall time. Step three is saving for your down payment. Even if you have a good salary and can get approved for a mortgage, the thing that might be holding you back is saving for a down payment. In the past, Calgary home prices have been rising so fast that, and oftentimes, savings couldn't keep up. Recently, the price growth has slowed down, which is good news if you're trying to close that gap. So here's the thing. If you're projecting that your monthly costs are going to be higher as a homeowner than what they are currently as a renter, then you need to start testing this budget and payments now. So for example, if your current rent is $2,000, but when you go to buy a home, you expect that it's going to be higher with the mortgage, taxes, fees, and it's going to be closer to say $3,000, every single month you need to be saving that $1,000. And then you take that $1,000 and you put it into a high interest savings account. This is going to do two things. It's going to help you grow your down payment, and it's also going to get you used to the payments that you need to make each month. This is important because when you start making those payments now, when you do eventually become a homeowner, it's not going to be such a shock to your lifestyle because you've already are used to making that type of payment. You won't feel like you suddenly have less money to enjoy your life because your spending habits will already match your new reality. Another thing that is crucial to helping you save for your down payment is tracking your spending. Now, you can buy finance planners and budget planners on Etsy or anything like that. They're quite cheap and quite easy to use. There's a wide variety of them. My wife and I started using these, and I gotta tell you, it's been a huge game changer in knowing what our income is and what our expenses are and how much we can actually save. This is not only gonna help you set clear savings goals, but it's also gonna help you see where you can cut back if you need. Step four is getting pre approved early. Getting pre approved is like buying a plane ticket before you get on the actual flight. You shouldn't start shopping for homes until you exactly know how much you can afford, and you should know your budget well in advance. A pre approval will confirm three things: it will confirm your price range, help you budget for a down payment and closing costs, and it'll make you a stronger buyer when it comes to putting in an offer. I suggest even if you're 2 to 3 years away from buying your first home, you should still go speak to a mortgage broker. By talking to a mortgage broker, they can help give you a clear plan. They can look at your income, your savings, and your credit score and show exactly what you would qualify for today and what you need to change to help you qualify for more. When you get pre approved, you're also going to need to decide between a fixed or variable rate mortgage. A fixed rate stays the same for the entire term of the mortgage, so your payment never changes, so it's predictable. A variable rate changes when interest rates change. Your payment could go up or down depending on the market. Now, depending on which one you want to go with, there are some pros and cons to both. Here are the pros for a fixed rate. Your payments will stay the same for you the entire term, which is easier to budget with no surprises. The cons of a fixed rate is that if the rates start to go down, you won't be able to take advantage of it if you were on a variable rate mortgage. And oftentimes, breaking the mortgage early comes at a cost of big penalties. Now, the pros for a variable rate mortgage, historically, they cost less over the long term. And if you need to break your mortgage, they're often a lot less than penalties. But the cons of a variable rate mortgage are payments can go up or down depending on the interest rate, which means it's less predictable, so it requires a higher tolerance for change. The best choice really depends up to your comfort level. If you'd lose sleep worrying about whether or not the rate is going to go up, then maybe the fixed rate is going to give you that peace of mind. But if you're okay with a little risk and want to potentially save more money over the long run, then a variable rate might be the best bet for you. Step five is thinking about your future needs. A lot of first time homebuyers, when they go out shopping, this is a big mistake that they often don't think about. Most people live in a home for about 5 to 7 years before they decide to move again. That means that the home you buy today not only needs to make sense for today, but needs to make sense for you in several years. If you skip this step, you may need to sell and buy another home, and that could be costly. And so, to help you out with this, here are 5 questions you should ask yourself before you buy. One, if you're planning to start a family or you have already have a family, what ages will you and everyone be in your home in 5 years? A 5 and a 2-year-old will end up being a 10 and a 7-year-old before you know it. Bedrooms, play space, and bathroom sharing can all change as kids grow. Two is what grades or life stages will you be at? Will you have teenagers learning how to drive or kids entering high school? Or will you be empty nesters with extra space that you don't need? Number three, will anyone be moving in or will they moving out? Are you planning on starting a family or are you going to be having a parent or a family member move in the future? Number four is where will you be working? Are you going to be in the office, hybrid, remote? Job changes completely, your commute and location needs can change quickly. And number five is what activities do you want to keep doing? Do you want to do outdoor sports, be near a lake, quick access to the mountains, or do you want to be in a more walkable community where you can access a coffee shop quite easily? Make sure you write these answers down because it's going to become your future needs blueprint. Step six is understanding timelines. Now, a big mistake that I also see buyers make is not understanding how long it takes to actually buy a home. And it can be quite stressful if you're renting and you're needing to move somewhere else. And so knowing your timelines is going to help avoid any surprises. Now, this will vary on person to person, but I'm going to give you an example on the most recent client that I had. The first step was the pre-approval, which took anywhere between 1 to 2 weeks. Then we went on to finding a home. Now, for me, on average, my clients can take anywhere between 1 to 3 months to buy a home, but I've had clients take anywhere up to 5 months before they found the right home for them. But for this example, my client only took 1 month to find a home. Then we put in an offer, which in most cases is only going to take about a day, but it can take up to 3 days. Then you have the conditional period, which here in Calgary could be anywhere between 7 to 14 days. Then, once you have a firm offer, from firm offer to possession date, that could take anywhere from an additional 30 to 60 days. So, the total time from pre approval to possession for most buyers is going to take anywhere between 2 to 4 months, and that's if everything goes smoothly. So, if you do have a specific move in date in mind, you should work backwards from that date. so you can plan your search accordingly and avoid any scrambling. Now, step 7 is the offer process. Now, when you go to write an offer on a home here in Calgary, in the contract, there's already some pre-written legal requirements that helps protect you, the buyer, and the sellers. But in the offer, there are 5 key components for you to focus. The first one is the price, which is obvious. That is what you are willing to pay for the home. The second part is the deposit. The deposit is the amount of money that you put up front once you have an accepted offer. And this is an additional cost, but goes towards your down payment. Typically here in Calgary, that could be anywhere between 3 to 5% of the purchase price, depending on the home. For example, if you're buying a $300,000 condo, you're probably going to be okay getting away with between $5,000 to $10,000. But if you're buying a home worth $1 million, sellers are going to ask for a deposit much higher, probably closer to $100,000. Now, when it comes to deposits, I usually get a couple of frequently asked questions. First, when is it paid? Your deposit is usually due 3 days after accepted offer, which will be stated in the contract. The second is, where does the money go? Your deposit will go into a trust, usually of the seller's brokerage, and it will stay there until closing. A really good tip for a deposit is to make sure that your money is ready and available before you make an offer. If your deposit money is tied up in investment accounts or locked accounts, this can cause delays and even jeopardize the deal. The third component of an offer are the conditions. The conditions are your safety net. They will give you time to do your due diligence on the home before you fully commit to buying it. Now, the most common conditions are going to be your financing condition, your home inspection, and if you're buying a home with a condo fee, you're going to also have a condo document review. Now, the reason you're going to need a financing condition is that even though you are pre-approved, the financing condition is one of the most important aspects to keep you protected. And so the real big difference between being pre-approved and actually approved is this. Your pre-approval is based on an estimate for your income, debts, credit scores, and a guess at the purchase price. Like, it's basically saying, yes, based off of what we know, you should be able to get this mortgage. Now, once you actually put in an offer and have an accepted offer, the bank now has a property to review. And so they're going to look at the appraised value, the condition of the home, the condo's financials if it applies, and your updated financials, like have you bought a car recently? And so you need to think of it like this. Think of the pre-approval like a dress rehearsal. The financing condition is opening night. It's the final check to make sure that everything is going smoothly before the curtains open. The home inspection is the home inspector coming in and checking out the condition of the home. The home inspector is going to check for any major defects or issues that could affect your decision down the road. We're basically checking to make sure that the home isn't cost you an extra tens of thousands of dollars to make repairs because we've already spotted them. And the third condition, only if it's applicable when you're buying a home that has condo fees, think of an apartment or a townhome, is a condo document review. In Calgary, you're going to hire a third-party condo document review specialist. They're going to review the condo's bylaws, financials, reserve fund, meeting minutes, and make sure that the building is well managed and financially healthy. The fourth component is going to be your possession day. The possession day is the day that you're going to get the keys to your home. This possession day needs to work both for you and the seller. Typically here in Calgary, the common possession dates are anywhere between 30 to 90 days after conditions are removed. But this can be shorter or longer depending on the deal. And the fifth component are the inclusions and exclusions of the home. This section spells out exactly what is to be included with the home. These are going to be things like appliances, window coverings, and furniture if negotiated. And it's also going to be telling what the seller is going to take with them. The best way to think about what stays and what goes is if you were to take the home, flip it upside down, and give it a shake, whatever doesn't fall off the wall or the ceiling is staying. And whatever does, usually is going to go with the seller. Step 8 is understanding closing costs. When you're ready to go buy a home, your down payment isn't the only money that you need to have ready. There are additional costs that come due from the time that you remove conditions to the time that you take possession. And if you're not prepared for them, they can really catch you off. The more typical closing costs are legal fees, title insurance, property tax adjustments, home insurance, moving costs, and condo fee adjustments. Typically in Calgary, you should budget anywhere between 3 to 5% of the purchase price. For example, on a $500,000 home, you should budget anywhere between $15,000 to $25,000 in addition to your own down payment. This range will typically cover your costs and give you a bit of a buffer for anything unexpected. Another thing that really isn't a closing cost, but it's something that a lot of buyers do forget about, is furniture. Almost every buyer that I've worked with usually underestimates how much furniture they're really going to need, especially if they're upgrading from a smaller place into a larger space. So for this, I recommend you budget early and see how much it might actually cost you to furnish a new home. Step 9 is understanding Calgary market before you go shopping. Before you even step foot into a property, you should understand what the numbers are telling you. Calgary's real estate market could look very different depending on property type, neighborhood, price point, and even time of year. So some key metrics that you should know are the average sale price, This is going to tell you what the buyers are actually paying for, not what the sellers are asking. Next is days on market. This is going to tell you how fast or slow homes are selling. If homes are selling in under 2 weeks, you're typically going to be in a competitive market. The list to sale price ratio. This metric shows you if homes are selling at, below, or above the asking price. And the last one is inventory levels or months of inventory. This metric is going to tell you how much choice you have as a buyer and how much negotiating power you have. Typically in Calgary, if the months of inventory is below 2.5 to 3, you're in a seller's market. If you're between 3 to 5 months, you're in a balanced market, and anything above 5 months of inventory is a buyer's market. Understanding these numbers are going to help you give a realistic expectations. It's also going to help you spot a good deal and allows you to make faster, more confident decisions. Now, the next step is the out of 10 method. You might have heard this before from many real estate agents, but it is one of the best ways to determine whether or not you want to buy a home. And so here's how it works. Every time that you go looking at a home, you're going to rank that home out of 10. But here's the rule. You cannot use 7. 7 is a very generic, gimme kind of number. It's easy to give. So you cannot use 7. And so here's what you're looking at. Any home that you rank below a 6, we're not revisiting and you probably shouldn't buy that. If it's at an 8, we might question whether or not you can make some investments in the home or renovations to turn that 8 into a 8.5 or a 9. If it's a 9, we're most likely going to be making an offer on this home. Now, rarely is there a home that is a 10 out of 10, but if you do find that home that is a 10 out of 10, buyers are probably thinking the exact same thing, and you should expect to be in a multiple offer situation. This works for a lot of buyers, including all of mine, is because one, it gives you instant clarity of the home. It's also going to remove any biases and help you avoid any influences that have come with staging or flashy features that you don't really need. And it's also going to help those top choices stand out a lot quicker. After a week of 2 of viewing homes, you're definitely going to see a pattern and see which ones you're going to want to stick to. The next step is calculating the true cost of home ownership in Calgary. Buyers, when they get ready to go purchase a home, only look at the purchase price and their monthly mortgage payment. That's a really big mistake that a lot of first-time homebuyers make in Calgary, because the true cost of owning a home here in Calgary is a mixture of both fixed and variable costs. These are expenses that you're going to expect every single month and every single year. So let's first start with the fixed costs. These are going to be more your predictable expenses. So these are going to be like your mortgage payment, your property taxes, home insurance, and condo fees if applicable. Your variable costs are expenses that can change based on seasons, the condition of the home, and how you live. These are going to be things like utilities, repairs and maintenance. I suggest that you save 1% of your total home value every single year dedicated towards routine maintenance and repairs, and any unexpected repairs that may pop up. Roof leaks, appliance breakdown, anything like that. This matters because if you understand the true cost of home ownership, you can confidently shop within your budget range and avoid becoming house poor. Okay, so that is the full breakdown of how to buy a home here in Calgary step by step from start to finish. If you follow these steps, you'll avoid the costly mistake that most first-time homebuyers make. You'll know exactly what to expect at every stage. If you're ready to start your home buying process, or you just want to have a quick chat about your future home buying plans, you can click the first link in the description and we can map out those steps for you. I can't wait to hear from you to help you buy your first home here in Calgary. Until then, take care.